Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and joining me today is Michele Hardeman, Head of State Street Global Markets Asia Pacific, to talk about investor confidence. Hi Michele.
Hi, nice to be here.
Thank you very much for being here. We're here today to talk about investor confidence and how the market has influenced that. I know that State Street have recently done an investor confidence survey, which interestingly, unlike some others in the market, isn't just based on opinion, is it? It's actually based on trades. And what has it found?
Well, we found that the Investor Confidence Index has come off quite significantly. Normally you look at 100 being the baseline, so currently it's at 88.3. So it shows that investors are actually investing in more risk-averse assets, moving away from the high beta assets and taking a much more conservative approach to their investments.
And are there any sort of regional disparities? Because this is a global index, isn't it?
We are seeing regional disparities. Europe has been up a little bit, North America's down and Asia's been down quite a bit, and I think you can see that reflected in the emerging market currencies. If you think about the flows that we've seen in recent weeks, obviously we are seeing a huge move in US Treasuries. We're seeing a wind back of quantitative easing, and that has a significant impact on the emerging market Asian currencies in particular. We would favour an investment profile that sort of looked at current account deficit countries versus current account surplus countries and favour those for investments. But certainly at the moment, the market's very concerned about the US Treasury market and the equity market and the interest rate differentials, and so the impact that will have on Asia.
And are they right to be worried? Because of course the way that investors act isn't necessarily the correct way, the way that fundamentals perhaps suggest, because we are emotional creatures, humans.
I think they're right to be concerned. I think when you start to have a big shift in central bank policy, that's when you normally get major turns in markets. And so if you think about the fact that the US are winding back their quantitative easing and having a much tighter sort of monetary policy, we anticipate there's going to be 3 further hikes into the next year, and that starts to weigh heavily on the emerging markets because people are buying back into the US markets or they're holding more cash. What ends up happening is that you end up seeing an export of inflation back into the emerging market countries, which is unexpected, and I think that people are now starting to think that the consequences of higher dollar are really going to start feed through to the emerging market currencies in a fairly significant way.
And why is Europe seemingly swerving this kind of negativity? Because of course Europe is not without problems. We've got Brexit on the horizon. Turkey obviously has been beset by currency issues. Why do you think that investor confidence is slightly higher in Europe?
I think that there are starting to see some general signs of inflation picking up in Europe. Obviously over the weekend you saw that the Brexit negotiations appear to be on a better footing. So I think people expect that there'd be some resolution there. The other thing to always remember about Europe is that a lot of European trade is within Europe, and so that they're less susceptible to the pressures of a strong dollar. The euro is still weak, and the sterling obviously had a fairly strong rally overnight. But I think that going forward, we would expect that the strong dollar will continue to accelerate.
Michele, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.